Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, so today is a very special episode. It's part of a series that we're doing for the Deal Flow event team on the upcoming Venture Debt Conference 2025 in New York City. And today, my guest is Jennifer Post, who's a partner over at Thompson Coburn LLP. And Thompson Coburn LLP is a sponsor of the Venture Debt Conference. First off, Jennifer, welcome to the show.
Thanks for having me, Adam. Good to see you.
All right, so I'm excited to have you on. I know that you're in my old neck of the woods. I used to be out in Century City as well. I'm out in far away in a land called downtown LA right now. But welcome and loving having some Century City individuals on the show. So Jennifer, how we like to normally start these episodes is something that we call our Mission Matters Minute. So at Mission Matters, our aim and our goal is to amplify stories for entrepreneurs, for executives, for experts, for people that we feel need to be heard. That's our mission. Jennifer, what mission matters to you?
Well, I think probably the mission that matters to me in terms of my practice is helping creative, free-thinking entrepreneurs exceed. There are a lot of playbooks around how things are normally done, and there's a lot of segregation around who does what type of work or what type of thinking. But I really like to work with entrepreneurs who are bending the rules a little bit, finding their own path, creating success kind of on their own terms. I'm an entrepreneur at heart too, which is why I think I like doing that. So I'm all in to help people who are kind of reinventing the wheel.
Amazing. Love bringing mission-based individuals on the line to share why they do what they do, how they're doing it, really what we can all learn so that we grow together. That's what Mission Matters is all about. So great to have you on. Let's go back in time a little bit here, Jennifer. When working with entrepreneurs, in this business and in this work, how'd you get started? Where'd all that begin for you?
Yeah, so I went to law school in Boston. I didn't start my career in California. And in Boston, there were, a handful of premier law firms, and I went to work for one of them. And that law firm specialized in venture capital, IPOs, and all types of work in sort of the private equity markets, mostly working with companies that were growing, scaling, and going public. So that's how I got started. I didn't grow up in a family like that. We were not business oriented, et cetera. But I really took to it when I had an opportunity to work with entrepreneurs and company owners as a professional. And that was a good, 30 or so years ago, right? So this has been a lifelong endeavor for me and a lifelong piece of work for me. What I find exciting about working with folks in technology and all types of related industries is that there are always new ideas, there are always new ways to do things, there's always innovation, there's always disruption, that's the buzzword, but there's always something new to think about and work on. And I did not come from a tech family or even really necessarily a business-oriented family. So I found it all new and exciting and challenging. And every day, well, almost every day, there was something new to think about and a new way to think about, helping companies grow and expand. And so those years were really sort of formative. I learned how to think as a lawyer, and I learned to appreciate kind of the spirit of entrepreneurship. And I did a fair amount of work, both in venture debt, even early on, and also more traditional corporate and M&A work. And I find that the venture debt work over these many years, it's been about 30 years or more, is a way to synthesize a lot of general business and corporate and lending work into one practice.
You know what? So taking that question just maybe a step deeper here. A lot of different ways you can work with entrepreneurs. Anything in particular that drew you to build a career in the VC space and working in that side of things? A lot of different spaces you could have worked in with your skill and background. What attracted you to that?
I think, a number of things. It's very dynamic, right? Entrepreneurs are passionate, they're excited, they're energized. There are people who form companies over and over again, but for the most part, there are a lot of entrepreneurs who have new ideas, new ways they want to do things. They're not kind of hamstrung by tradition and large institutions and, sort of old ways of thinking. They're really finding new paradigms for business, for revenue, for growth, so forth. And that pushes you as a lawyer, right, to be creative with your clients, right? Because no two business models are the same. No two companies are the same. No two entrepreneurs think exactly the same way. So it is a way to work with fresh ideas, newness, energy, kind of
Mm.
all the time. And you have to bring experience, and obviously the way you did things in the past or the way you've done things traditionally matter. But at the
Mhm.
end of the day, entrepreneurs are really pushing barriers, and that is really
Yeah.
fun to be a part of as a lawyer.
Amazing. Switching it up a bit here, talking about present day. Let's get into what's going on present day, specifically with VC or VC lenders. What kind of devices or structures are they using to extend their runway for their borrowers present day, like
Yeah.
with the current market? Like what are you seeing?
Yeah. Well, just, 30 seconds on venture debt 101, right? So
Yeah.
the kind of the crux of it in terms of its purpose and its usefulness and the capital structure is to extend runway, right? Is to
Yeah.
give capital backed businesses additional working capital so that they can achieve profitability or certain milestones or an exit or
Hmm.
certain, kind of market penetration levels. And the benefit of venture debt is that it should be non-dilutive to the founders and to the folks
Hmm.
sitting kind of in the capital stack already. So venture debt is designed in a sense to, propel and sustain the operations of scaling companies until a more natural exit or a more natural funding source can be located. So what's happening in the market is that the equity markets are slow. There are not as many exits into the public markets. The
Hmm.
private equity markets have slowed down. There's a bit of uncertainty. So the numbers of companies getting traditional equity financing on the private side is
Hmm.
slowing. And that's both
Hmm.
companies that have had equity and companies that would otherwise be qualifying for more equity rounds in the
Hmm.
future. And so the venture debt players may be in already. They may have gone in at a time when these companies were scaling quickly and getting equity, or they may be
Yeah.
in companies that have had delayed equity financings for a bunch of different reasons. And
Hmm.
so it's become a challenge, I think, for a lot of venture debt lenders and companies that are struggling to raise equity and struggling to wait out the time for an exit to keep the operations going. So a few different levers that the venture lenders are pulling if they have the capacity to do it in
Hmm.
their portfolio. One is just extending the interest only periods,
Yeah.
right? Paying amortizing debt payments is a burden for companies. They need the cash flow to operate. So folks are extending out the interest only runways. That is also coming with certain other features, right? Like
Hmm.
PIK or payment in kind interest. There have been a lot of articles about this in the private credit
Hmm.
markets. People are using PIK more and more often documenting loans from the beginning with PIK
Hmm.
interest. And PIK lets borrowers either accrue 100% of the interest to their capital principal amounts, accrue part of it, could be like a 50-50 arrangement with the lender, or accrue it on a toggle, right? If they have,
Hmm.
some, milestone events, they pay the interest in
Hmm.
cash. If they don't, then they pay the whole thing in PIK. So there are a few different ways, and those are probably the two most common ways that
Hmm.
venture lenders are extending, amortization and maturity, and then also giving a borrowers a chance to accrue or pay the interest in kind rather than lay out the cash, which obviously puts
Mhm.
more cash back on the balance sheet and allows the borrowers to operate for longer periods of time or accelerate operations depending upon
Mhm.
what they need to get to the exit, to get to a place where they can refinance, and ultimately to get to a place where that debt can be satisfied.
Mm. So maybe taking it one step further, like how can this be affecting maybe some of the other portfolios? Like
Yeah,
how
so
would
I
you see
think,
that playing out, especially
yeah,
if it continues longer term?
yeah. So, there's a lot of editing, I think, going on in portfolios, both on the
Okay.
equity side and the debt side. And it's just reality. I think for, some venture debt lenders, I've seen it happen across portfolios, some with my
Mhm.
clients and some with respect to other deals I'm in other capacities. And I see what the lenders are doing.
Mhm.
A lot of folks are, using any one of those mechanisms plus,
Yeah.
converting or writing off the debt, right? They'll just convert it to equity. The company does a recap and the debt says, well, we're going to write some of this off and just kind of
Mhm.
see what happens on the equity side. And that obviously hurts valuations because if you're a debt fund,
Mhm.
you really want to value the portfolio based on the strength of your debt ROI, right? So if you're carrying equity, you're
Mhm.
already a little out of whack. It's
Yeah.
also hurting some lenders in their portfolios because they're managing multiple funds. They're always
Mhm.
fundraising. They're always in front of their LPs. And so they always want to be able to sustain the highest valuation possible for their
Yeah.
portfolios. And if they're accruing PIK, there's a question as whether or not that's true value to the loan, right? If they'll ever
Mm.
really see that because they're not getting current interest payments. And the other downside to not getting a full amount of current interest payments or to not getting
Mhm.
exits and returns, kind of naturally or per the normal cadence of a debt fund is that you can't redeploy the capital.
Mm.
And recycling cash is a big part of what debt funds do. It's normal. This is how they operate. But if they're
Mhm.
not getting that cash in through interest or through exits or through pay downs, then they don't have that additional cash to deploy.
Mm.
So that's part of it. And then there's always pressure to deploy capital, right? So if you're in a
Yeah.
market where you can't justify a lot of new credits or a lot of, substantial credits,
Mhm.
you've got to tell your LPs you're not calling capital sort of on time or as expected. And that doesn't make LPs very happy, right? Because they want to make money by deploying capital and they've made certain allocations for the quarter, for the year, et cetera.
Mhm.
So I think it has just been a challenge for a lot of managers to deal with valuation issues, to deal with managing LP expectations, and ultimately to deal with write-offs or other, sort of editing
Mm.
activities inside their portfolio. And like all managers on the equity side as well as on the debt side, sometimes you have to figure out where it pays to walk away
Mhm.
because the amount of time or effort or kind of ancillary costs to manage underperformers just may not be worth it if you have other things in the portfolio you can focus on.
Mm. And speaking of challenges, I think having a conversation like this, we definitely need to bring up maybe challenged borrowers
Hmm.
and that piece of it in respective to VC lenders. What should they be aware of when it comes to managing exits for, let's say, challenged borrowers?
Yeah, I think there are a lot of issues. Some of them are sort of in the bucket of traditional
Mhm.
matters, and some are in the more the more business challenge matters.
Mhm.
On the traditional side, the issues list is somewhat familiar, right? Like, what do you do, and how do your documents look in terms of a bankruptcy? Who do
Mhm.
you compete with in a bankruptcy if there are other lenders who are going to offer financing? What is the debtor's strategy in a bankruptcy? Are there assets there you can foreclose on after the
Mhm.
filing is made? So having an understanding of all the bankruptcy, we have a mechanism called the assignment for benefit of creditors, ABC, which
Mhm.
is like an out of court bankruptcy, and other sorts of insolvency laws. Like, are you ready and do you know what your strategy is versus your borrower's strategy
Mhm.
in looking at one of those outcomes? And those outcomes, sometimes they're favorable for borrowers and sometimes they're more favorable for lenders. Again,
Mhm.
the question is, where is this bankruptcy going to occur and what is the upshot going to be? And by the way, a lot of deals are cross border. So sometimes looking at these insolvency matters in other jurisdictions is
Mhm.
something that's going to rise up the list more quickly. On the
Yeah.
less traditional side, maybe even sort of the less technically legal side, which is what
Mhm.
I find interesting, is that if you are a lender who has, in good faith, worked with a borrower and there's been maybe interim equity, or maybe you've
Mhm.
extended loans on a kind of an interim basis to help get to an exit, the real question is, will the board of directors and the shareholders existing in the capital stack
Mhm.
approve an exit that makes you, the lender, whole, but not necessarily all of the equity holders,
Yeah.
right? So there comes the tension, right? What does the lender need to get out? What does the capital stack want, right? Because
Yeah.
people want to get paid all the way down to the bottom of the waterfall. Is that a realistic exit? Is it an exit that can be done in a time frame that makes sense? The company will still be operating.
Mm.
And also, it's people act out of self-interest, and they should, right? Someone's
Mhm.
a venture capital investor, they put a lot of money in the company, they want to get a return, right?
Of course.
But they can't sell the company without the lender's consent. So there's a lot of negotiation that happens in later stage companies that are distressed, that need an
Mhm.
exit, that can have an exit. And the question is, who's really going to approve that exit? Who's going to stand in the way?
Mm.
Who's going to participate? Who's going to be difficult? And that all drives to, who's on your board,
Yeah.
who's in your capital stack. Are they sophisticated people? Are they family members?
Mhm.
Are they just, high net worth people who thought it would be fun to invest? I mean,
Mhm.
these things matter.
Yeah.
And then on the flip side, you could be dealing with very large equity funds, right? Very large venture capital funds who we were talking about it earlier, who might have just edited this particular position like it's out of their portfolio. Like
Mhm.
they just are not going to spend time on it. A lot of entrepreneurs want to work with big funds, but big funds have a way of not caring, unless it's
Yeah.
going to push the needle for them. So it's a very interesting conversation. It
Mm.
can be stressful, of course, for all sides, but it's a very interesting conversation when you have a nice, amount of debt at the top of the stack, either because it's accumulated over time or there's been PIK or all of the above, and there's an exit opportunity and the investors sitting below the debt are just not happy with it, or they're, frankly greedy, or they just feel that there's a better return, or, they have reputations in the market. So it's a very interesting conversation when there's an exit that could work for the lenders and could work for some of the equity, but doesn't really work for all the equity. And then how do you have that conversation? Because ultimately the board and the equity people can determine whether or not to go into a sale, right? The lenders can push you into a sale, but there's always a slightly better outcome when it's voluntary. So a lot of conversations there. It's very, very interesting place to be a part of it. And it really goes to the negotiating strength and negotiating sort of sensibility of the lenders, right? If you pound your fist, you don't get stuff, but if you pound your fist and offer something, you can get a pretty good outcome.
Amazing. I understand that I know Thompson Coburn is supporting the venture debt conference, and there's going to be correct me if I'm off on this, there's going to be a panel, right? A panel discussion. Yeah. And what's that going to be? A high level, keeping it high level. We don't want to spoiler that for the people that are attending, but tell me a little bit about that.
Yeah. So, there are going to be panel presentations throughout the day, but we're hosting a panel about sort of the timing of venture debt and kind of the leverage points of negotiating venture debt at different points in the life cycle of a scaling company. So what does it mean, and why would you do your debt deal like in connection with an equity round, after an equity round, before an equity round? Yeah. And then also how does that look, and how does it play, and what are the dynamics if you're doing venture debt to support acquisitions, or to support a specific acquisition for a company? So we're looking at leverage points between borrowers and lenders at different kind of capital moments in the company's life. And then, leverage points at a time of acquisition, and what do the lenders require for acquisition. And again, venture lenders, unlike banks, tend to be less formulaic. I wouldn't say that they're not formulaic, but way less formulaic. And so there's a lot of dynamism and discussion when you're raising venture debt. And so we have 3 folks on the panel, very experienced people in debt and equity. We're going to be talking about, what it means to raise venture debt at different stages of growth in terms of the capital raising. Going to be a great panel. So
you got to go if you're watching this venture debt conference. Put it in, go. Amazing. And I don't know if I'm going in person yet, but I'm going to definitely be watching some of the recordings and everything else, because big fan of the conferences, really all of them that Deal Flow Events puts on. But venture debt one's going to be an amazing one as well. That being said, Jennifer, first off, this has been a great discussion. I learned a lot. I'm up to date on the trends and what's really going on in the VC space. What's next? What's next for you? What's next for your career?
Well, I love what I do. I'm going to keep working with venture debt clients and folks that, fund the venture debt clients. There's all kinds of asset managers out there that are looking to get into venture debt. It's a pretty dynamic time because the markets are, unpredictable, which always leaves some room to be creative. So I'm going to keep doing that. And my short list is going to the U.S. Open in New York in September. I'm a big tennis fan, so I just was out in Indian Wells and hope to get out to New York in September. So
that's what I'm talking about. It's not all work. There's some play out there. That's what I'm talking about, Jennifer.
For sure.
Last thing, if somebody wants to continue the conversation and to learn more about either your practice or Thompson Coburn in general, how do they do that?
Yeah, that's easy. So you can go to our website, thompsoncoburn.com, and you can look me up and send me an email, or feel free to connect with me on LinkedIn. I check that really frequently. I will be happy to talk about all things entrepreneurship, venture debt, corporate law, M&A, anything that touches growth companies. That's what I'm interested in.
Perfect. And for everybody watching, just so you know, we'll definitely put the links in the show notes so you can just click on them and head right on over. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. Each and every day, we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So again, hit that subscribe or follow button. And Jennifer, thanks again for coming on the show.
Yeah, my pleasure. Good to see you, Adam.